Hello, everyone. Welcome to Couples Create Cash Flow. My name is Jordan Johnson. I'm your host for today. And today we're going to look at specifically how to pay your house as fast as possible. Let's jump in. It's a little known fact that you can actually pay off your house using a tool that I really personally enjoy called a HELOC. And we're going to talk a little bit about that towards the end. But first, I want to kind of jump into this by saying I love helping people to go from debt and stress to financial freedom. So if you feel like there is some heaviness weighing on you with your finances and you want to look for a way to pay off your debt and move to that freedom, I can help you. So your first 60-minute coaching call is free. And then after that, if you want to continue working together with me after we kind of talk over where your finances are, I can provide hour-long sessions at your own convenience or even some support by email with a weekly subscription or a monthly subscription. And you can package deals of sessions, or you can kind of jump in one at a time. There's a lot of different options for everyone. So feel free to reach out at my email, couplescreatecashflow@gmail.com, and I'd be happy to connect with you and chat about your specific situation. All right, so we're looking today at the topic of paying off your house early. And for many, many people, this is their biggest debt, their house, their mortgage. And most of the time, it's because the typical American family moves or refinances every 5 to 7 years. So that resets their mortgage term. And home mortgage interest rates lately, as you all know, have risen. So if you have applied for a mortgage within the last year or two, I'm recording this in 2024, August of 2024, you know that interest rates are higher than they were a couple of years ago. So while we look at kind of the ups and downs of interest rates, we also have to think about what is actually happening with the tool that we're using. So the average volume, not the rate, but the volume of interest during the first 7 years of a 30-year mortgage is actually 85%. If you have a 7% annual interest rate, the amount of your payment that's going towards covering your interest costs over the first 7 years as a whole, 85% of that goes towards interest. When I first started looking at these numbers, I was shocked. I was absolutely shocked. Because initially you're like, oh, great, here's my payment. My interest rate is, a single digit number. Can't be that bad, right? But 30-year loans in particular are well known for having most of that cost come up front. And that's because the interest rate is applied to a very high balance. It's the highest balance that you're ever going to have on your mortgage is right at the first few years. So let's talk a little bit about a couple of questions. First of all, if your loan's at 3%, why even think about paying it off? I've had a lot of people ask me that question. And to be honest, I mean, you certainly don't have to. 3% is probably about as cheap funding that you can possibly get at this point. There are a lot of people that refinanced or bought with lower than 5% interest rates. And personally, I had a loan that was 3% or sub 3% before I had to sell my house and buy something else. And now I'm sitting in something that's more like 7. So I think for a lot of people, as long as you can hold on to those old loans, you might feel like, oh, I don't want to give it up. Now, I will say that's fine. However, make sure you're looking at the volume of interest that you're paying every month because even with a 5% loan, um, this 30-year loan at 5%, 5 years into the loan, still has an interest volume of 53%. So when I talk about this volume, what I'm speaking to is 53% of your payment is going towards the interest costs that are associated with your loan. And most of the time, if you look at pretty much any 30-year loan, I think anything with like 3.5% or higher, by the time, if you were to keep that loan for the full 30 years, you'd be paying double what the house was worth originally. And that's because of how the 30-year loans are structured. So 30-year mortgage is a very safe investment for a bank. Think about it this way. If you're the banker and you want to make sure that you can have a long-term payment, monthly payment coming back to you at a very predictable, steady rate, and to have a collateral item like a house where people have to live in, this is a great investment for a bank. And even the actual mortgage that you get on your house can be sold and traded within different banks and different investment companies. And so you'll see loan servicing companies purchasing your mortgage from your original loan officer's company most of the time after you close. And so there's a lot of financial um, activity going on behind the scenes when you talk about the 30-year mortgage. Now, a lot of us, we like the 30-year mortgage because it provides a stable monthly payment and it's lower. So if you think about, if I had to pay off my house in 10 years, boy, that payment's going to be really high. You spread those payments out across 30 years. Oh, great. Now I can live in this house for cheaper than it would cost to rent it. And as I'm making the payments, I'm building equity in my home, right? No problem. Um, and that's fine, right? I mean, that is one thing that we appreciate here in America is we appreciate the ability to balance our budget and that sort of thing. And with this particular tool, they look at the very beginning. If you were to take 360 payments and spread it all the way out, this is your same payment every single month for your whole term. And so as you make your payments, the split between your principal amount and your interest amount, it actually changes every month. You'll want to look at your mortgage statement and actually see your principal and interest portion of your payment is going to be split up into two numbers that get combined together for your principal and interest. And at the very beginning, you may actually be paying a lot more towards interest than you expect. So I would just recommend go ahead, look at your mortgage statement, look at your payments history, kind of see how much principal you paid and how much interest you've paid, especially if you're within the first 5 years of getting that loan, you'll be surprised at how little you've actually paid down on the original balance, even though you've been making many payments. So, like I said, it helps people to budget. So if you're thinking about this massive amount of money that it takes to buy a house, it's really hard to pay that up front with cash. Nobody really is able to do that. Most people can't, at least. And so you're going to need to find a way to fit it into the income that you have every month. Um, and so the bank says, okay, here's the same monthly payment, but the catch is as you're making payments, they're going to take that money and credit it to your balance. But they are playing by the rules of a 30-year repayment. Even if the average person stays in a home for 5 to 7 years, they're spreading it out over 30. So that means they can take that higher amount of interest payment at the beginning. And that's because we're really sticking with that exact same, if we were smart, we would actually choose to make our principal payment be the same and let the interest payment fluctuate. For example, let's say we had a $300,000 loan, and each month that we're making a payment at the very beginning, we're making like a $250 chunk of our principal, even though we're paying like, let's say $2,500 a month or something like that, or $2,200 a month. We're only really hitting like 10% of that towards interest. It would be wiser for us to have some kind of tool where we said, hey, I want to put $500 of principal towards this every month and double it, or something like that, where we'd actually be making more progress on the principal. But really, we as Americans don't want to have to think about all that. So the nice thing about it is we don't have to. Banks have provided this to us. Here's what we can do is we can make additional payments to pay down our loan. Now, the thing about that is, as we pay our loan down, it doesn't change our monthly payment. Unless, of course, you pay down so much that the bank sends you a letter in the mail and says, hey, we can recast your loan now. We can spread it, spread the remaining balance out for the amount of time that you have left and actually lower your monthly payment. And for some people, great, that's awesome. But it's a way to try to make sure that you are continuing to make those payments for as long as possible. One thing I missed here is that mortgages are closed or one directional. And a lot of people don't think about this. They're like, yeah, of course. You pay the bank, they don't pay you anything back, or they don't credit you anything other than the balance is going down on your loan. So as you make payments, you can't actually access that equity. So if you made a monthly payment and added $500 of equity to your house, you can't use that money, right? And most of us are like, yeah, of course not. I've made that monthly payment. It's like paying rent. Paid to my landlord, can't get it back. Well, same thing. The bank is kind of your landlord. Make a payment, can't get it back. So this is where a HELOC steps in, because the HELOC is a line of credit based on the equity that you have in your house. Most people think about a second lien HELOC, and I do enjoy second lien HELOCs. This type takes a position under the mortgage. So you keep your original mortgage, and then you have a separate line of credit called a HELOC that is in second position. So the lien, that's a fancy lending term, meaning that if you stop making your payments, they will actually be able to take the proceeds from selling your house. First position lenders are going to get the top priority if you go into foreclosure and your house has to sell at an auction. If all of their funds are returned to them and there's something left over, it would go to the second position lien. So if you do this, let's say you have a 3% loan. Let's say you've been paying down your house for a while and you've made some really good progress and you have like $100,000 of equity sitting untapped. Maybe you want to speed up your repayment process. Maybe you want to actually tap into the equity that you can't actually use. Second position HELOCs are perfect for this because you don't get charged any interest unless you actually use the money. The way they figure this out is they take the value of the home times 90%. Okay, so let's take an easy number, 500,000. Okay, 10% of 500,000 is 50,000. Take $50,000 off the total value of the house, 450,000. So the max that they would be able to go up to is 450,000, but maybe you have a mortgage out there for 350,000. Okay, there's that $100,000 equity between 350 and 450 that a second position HELOC would come in and say you can have access to a credit or a line of credit that is up to $100,000. So this creates some liquidity for you. And liquidity is something that you lose quite a bit of if you're making extra payments on your mortgage without a HELOC. As you make, extra payments and you're getting excited about, not having to pay that interest later on, you're sacrificing liquidity right now for the ability to not have to pay the extra interest. But with a HELOC, you're actually creating liquidity by tapping into the equity that you've already created. And then as you make more payments on the balance of your mortgage, you aren't sacrificing the security that you can have with it, tapping into the equity of your home. Now, as you look at your whole lending situation, obviously you've got the 90% of your value. That's like the total amount that a bank would lend up to. If your mortgage is taking up a big chunk of that, it's going to limit how much you can get access to with a second position HELOC. So the second position could have a lower limit if your mortgage is still being in play and if it's still large. And it doesn't take away your mortgage payment. So you're going to have enough income to be able to support your mortgage payment plus your HELOC. And for some people, that is a challenge because if you just barely qualified for the full 30-year payment, then you might not have enough extra income to support a full HELOC on top of your mortgage payment. And that's how the banks will look at it, is they'll look to see not just what your HELOC payment would be if you had it half full. They're going to look to see what would it look like if you had it full all the time. And that is one thing that we have to look at is, does your income support it? The other thing is that you have to make sure you have enough equity to make it worth it to get a HELOC. Now, there's not a lot of closing costs involved with a second position HELOC. A credit union that I've used in the past was very easy to work with. Within a couple of weeks, I could pay $500 for an appraisal and another $100 to get the line going, and then I'd have access to it. It doesn't have to be very expensive. And I've actually had my house appraised using a very conservative electronic system where they didn't even have to send out an appraiser. I got a little bit less on the value, but it saved me $500 for getting the appraisal. So that's also an option out there if you have a good credit score and a good relationship with your banker. So this is often called velocity banking, using a HELOC to then make payments on debt. So we can apply that towards debt on the house. And this is how we're going to do it. We're going to actually take the funds available in the HELOC and we're going to pay down large chunks of money towards our debts. In this case, it would be towards the house. We're going to get our paychecks direct deposited into the HELOC, and that's going to actually reduce the amount of interest that we're owed as soon as the deposits are received. We're not going to have an extra payment each month for the HELOC because every time our paychecks come in, it counts towards a payment. All of our payments go towards principal. Once a month, there will be a payment that takes care of the interest, and so a little bit of that paycheck money would go towards that. And then as you pay that down, you consider how much money should I chunk towards my debt. Now, when we think about putting money towards a fixed one position loan, like a mortgage, from a revolving line of credit, like a HELOC, we have to remember that our income is actually what's helping this whole thing work. So we need to be able to have some cash flow each month. If we have about 500 to 2,000, I mean, obviously more than $500 a month in cash flow, we can actually look at how fast we're going to be able to make that payment back. So what I say is take a monthly cash flow number. Let's say it's $500. Multiply that by 12 months or a full year. So $500 times 12 is $6,000. That would be our maximum chunk. So we would actually take $6,000 from the HELOC and we would make a premium only payment to the 30-year mortgage. And that would reduce the 30-year mortgage's balance by $6,000. Basically, we would transfer that debt over to the line of credit. Now, the other side of this is, let's say you have quite a bit of cash flow. The other part of this that you have to look at is, what is your HELOC limit? If you have a very large limit, like $100,000, this is actually going to be less important than your income. But when we're looking at the usage of the HELOC, we want to make sure we don't use more than 2/3. So you can multiply your limit by 0.66 or 66% to figure out what is the maximum amount of that HELOC that you'd want to tap into. I always try to tell people you'd really want to leave a good chunk in your HELOC that you never spend because it's going to help your credit score. And it is kind of like an extra savings account for you. So it'll keep your credit score healthy. It'll also keep you from going underwater on the value of your house if the market were to dip down a little bit. So let's say you've done this, here, we'll stick with this one for a second. Let's say you've taken this money, you've transferred it over to your HELOC. Now you're going to actually be taking your paychecks. And as your paychecks come in, they're going to be lowering the balance. And so instead of with a mortgage where you make one monthly payment, it drops a little bit, and then it's steady and flat, and then it drops a little bit the next month, it drops a little bit, because you're really not making much progress on the premium. What happens with the HELOC is you get the paycheck, it drops down. Get another paycheck, it drops down. Maybe your credit card comes up and the bill comes due and your balance comes up. You get another paycheck, it comes down, another paycheck, it comes down. And what you end up seeing is an up and down pattern that eventually brings you down much faster than the balance on your mortgage by itself. The other thing is, as you apply a large chunk of money towards your main mortgage, you're basically speeding up the amortization schedule. I would highly recommend going online, finding an amortization schedule for a 30-year mortgage, and trying to line it up with when your mortgage got started, and look at the actual schedule. Look at how many months, month by month, what your premium payment and your interest payment, and then how much you've actually paid off in principal, how much you paid off in interest. What ends up happening is, let's say $6,000 gets applied to the premium. In most mortgages, if you're in their first 5 years, $6,000 applied to premium might actually speed up your whole mortgage payoff by 5 to 10 years just by making that one payment on top of your normal monthly payments. And we know we're only going to take 1 year to pay this HELOC off with our cash flow. And so if we can gain, let's say 6 years of not having to pay interest on our 30-year mortgage, if we drop that from 25 years left to, let's say we cut 5 years off, and from 25 years to 20 years. Now we've got 5 less years of paying interest. And even if it's a low interest rate, that's going to mean a lot of saved money in interest. The other thing it does is it actually gets paid off within a year. And as you pay off that money, you now have access to that money again. You make that $6,000 payment again, you speed up your mortgage a little bit faster. take another year to pay it down. So this is all about using your home's equity to gain more equity. And it's all about using your cash flow every month to pay back the chunk. Now, this takes some discipline. This takes some practice. It means that you're going to have to know where your money's flowing in and flowing out. You got to make sure that you're cutting down unnecessary spending. You're going to have to make sure you're making some extra money to make it go even faster. But even if your HELOC is at a higher percentage than your mortgage, even if your HELOC is maybe 2 or 3% higher than your mortgage, the way that the mortgage interest is calculated over 30 years versus the way that your HELOC interest, which is calculated with simple interest based on your balance, average daily balance over the course of 30 days, you actually pay less volume of interest doing it with the HELOC. All right, here's another thing to talk about is a first position HELOC. First position HELOCs are all about actually getting rid of your mortgage and making one payment into a HELOC. So instead of having that monthly payment to your mortgage, first position HELOC comes in at 90% of your value, takes care of the mortgage, pays it off. Now you have a HELOC loan or line of credit that is up to 90% of the value of your house, and you take the mortgage amount that you would have had. So let's say we go back to the $500,000 house. Your limit would actually be 450,000, but you would actually have 350,000 already on there. So you'd be paying your monthly payments on that 350,000. However, what's going to happen is it's a HELOC. So as your monthly income comes in and your expenses go out, you don't actually have to make a payment. So the money you would have normally spent on your mortgage all goes towards your principal. It goes a lot faster. And I have a master class that I'm going to link in the description below. Go ahead and watch that video. It's about 45 minutes. It goes into depth about the difference between how long it takes to pay off a 30-year loan versus paying off your loan with a HELOC. It's drastically different. And so I go through how you can pay your house off sometimes in less than 10 years, depending on how far along you are. You can always save tens of thousands of dollars in interest costs if you do it this way. And I'm going to actually show you in that master class how the math works with some real examples. So just want to reiterate, I do help guide people from debt to stress, or debt and stress to financial freedom. So if you have any debt and you want to pay it off outside of the house, I can help you with that. If you're like, I just want to crack this house out, make sure I'm done with this, not have this house payment anymore, I can coach you through that. And yeah, the first 60-minute coaching call is always free. So give me an email, let me know what your situation is. I'd be happy to help. All right, thanks for watching.